Hello, dear listeners. My name is Jyot Kaur and I am from BCom Financial Services. I feel glad to give this seminar under the sole guidance of our HOD ma'am, Dr. Mrs. Kanwaldeep Kaur. The topic for my seminar is Reporting by Diversified Companies. In recent years, diversification has mainly occurred due to internal expansion. Consolidated financial statements are prepared and presented to disclose financial information on all different segments of a diversified enterprise. It has been noticed that financial statement users group find segment information more useful and valuable in assessing an enterprise standing, its past and future prospects. So, diversification binds itself to the saying survival of the fittest. Hence, need of diversification arose. A diversified company is a type of company that has multiple unrelated businesses or products. Unrelated businesses are those that require unique management enterprise, that is, they have different end customers. A few examples of diversified companies are Godrej, Reliance, P&G, Tata, Nestle, Pidilite, Dabur, Hindustan Unilever Limited and Amul, etc. Currently, accounting standard related to segment reporting is AS 17 issued by Institute of Chartered Accountants of India with effect from 2001. Segment reporting is the reporting of the operating segments of a company in the disclosures accompanying its financial statement. It is required for publicly held entities and it is not required for privately held ones. It is intended to give information to investors and creditors regarding the financial results and position of most important operating units of a company, which they can use as the basis for decisions related to the company. So, why segment reporting is required? Number 1. Users of financial statements can better understand the performance of any enterprise. Number 2. Users of financial statements can better assess the risk and returns of any enterprise. Number 3. Users can make more informed judgment about the enterprise as a whole. And 4th, users become aware about the impact of changes which a significant business component may have on the business. So, where is segment reporting used or applied? Number 1. Enterprises whose securities are listed on stock exchange. Number 2. Enterprise whose turnover exceeds rupees 50 crores in an accounting period. And number 3. Voluntary process by enterprise. Identification or basis for segment reporting. Business segment. A business segment is a distinguishable component of an enterprise engaged in different product or service lines. It provides an accurate picture of public company's performance to its shareholder. Geographical segment. A geographical segment is a distinguishable component of an enterprise engaged in different areas having different risk and reward system. For example, business segment in case of Godrej Consumer Product Limited is home care, personal care, real estates and electric appliances, etc. Geographical segment in case of Godrej Consumer Product Limited is Africa, India, Indonesia, etc. Identification of primary and secondary segment. Almost all the entities having both business and geographical segment must identify and report information in two formats, that is, primary segment and secondary segment. Process for identification. Number 1. Segregate the business and geographical segment. Then assess the risk and reward of these segments, and finally identify the dominant segment. Dominant segment. It refers to the segment which earns maximum profits for the enterprise. It may be business segment or geographical segment. If both the segments are equally dominating, then primary segment is equal to business segment and secondary segment is equal to geographical segment. Reportable segment. Reportable segment is the segment for which disclosures are required to be made in the annual report of the company. It is a business segment or geographical segment for which segment information is required to be disclosed by the guidelines of the AS17. A reportable segment is an exploitable segment that makes up at least 10% of the overall business revenue or assets. Criteria for identification of reportable segment. Number 1, revenue test. Number 2, asset test. Number 3, profitability test. Number 4, previous year criteria. And number 5, maximum ceiling. Revenue test. If a segment's revenue is greater than 10% of total of all the segment's revenue, then it is called a reportable segment. Segment revenue is equal to external sales plus internal segment sales. Profitability or result test. If a segment exceeds 10% of either combined results of all segments in profit or combined results of all segments in losses, whichever is greater in absolute terms. Let us understand profitability test with an example. For example, XYZ Limited having 4 segments, segment A with profit 2 lakhs, segment B with loss of 1 lakh, segment C with profit 3 lakh and segment D with loss of 2 lakh. Combined profit is equal to 5 lakh. Combined loss is equal to 3 lakh. Rupees 5 lakh is greater. So, 10% of rupees 5 lakh is equal to 50,000. If segment's results exceed rupees 50,000, then it will be a reportable segment. Assets test. If a segment's assets is greater than 10% of the assets of all segment, then it is called a reportable segment. Previous year criteria. Any segment is treated as reportable segment in previous year. It will continue as a reporting segment in current year too. Maximum ceiling. The revenue of all the reportable segment should be at least 75% of the enterprise revenue. If not 75%, management have to make more segment to the reportable segments list till the threshold of 75% is reached. Discretion of management. If a segment does not meet any of these tests, even then the management can discretionarily choose its reportable segment. Restatement of previous year data. If any segment which has been reportable segment in the current year but was not the reportable segment in previous year, then the accountant have to calculate its previous year's data into segment reporting. This is called restatement of previous year data. What is to be disclosed? Number 1, segment revenue. It represents revenue of a particular segment. It is the separate income generated by each segment of the company. In computing segment revenue, certain items of income should be excluded as provided in the standard. It includes direct revenue, internal segment income, allocated income, and it does not include extraordinary item. Inter-segment transfers. The inter-segment transfers should be disclosed in the segment income statement. The amount of such transfers should be shown either as a separate line or by footnote. Number 3. Segment expenses. This represents the expenses incurred by a particular segment. It is subject to exclusion of certain items of extraordinary expenses prescribed in the standard. It includes expenses directly attributed, expenses on transacting with other segment, allocated expenses, but it does not include extraordinary item. Number 4. Extraordinary items. Extraordinary items are those events that are unusual and infrequent. In simple words, these are abnormal and do not relate to principal business activities. They also are not predictable or occur on regular basis. For example, loss in natural disaster, earthquake, tsunamis, fires, etc. Number 5. Segment result. This denotes the difference between segment revenue and segment expenses and represents segment profits or losses. Number 6. Segment depreciation and capital expenditures. The depreciation charged on segment's assets is to be disclosed in the segment report of the company. The capital expenditure incurred on the segment's assets should also be shown in the segment report. Number 7. Segment assets. Segment assets are those assets that are employed by a segment in its operating activities and which are directly attributable to the segment or can be allocated on a reasonable basis. It includes operating assets directly attributed, operating assets allocated on reasonable basis, including goodwill if that can be attributed on reasonable basis. But it does not include income tax assets and corporate assets. Number 8. Segment liabilities. Segment liabilities are those operating liabilities that result from the operative activities of a segment. It includes trade payable, accrued liabilities, customer advances, product warranty provisions, other claims related to goods and services. Number 9. Accounting policies. Investors can improve their predictions when the business enterprises disclose sufficient information regarding the impact of change in the accounting policies of their earnings. It discloses information related to basis of segmentation and inter-segment sales and trades. Arguments in favor of segment reporting. Allocation of resources, investments and credit decisions, true and fair view, separating profitable segment, improved reporting concept and helps to focus on weak segments. Arguments against segment reporting. Basis of segments, allocation of common cost, pricing inter-segment transaction, cost of segment disclosures, competitive disadvantage, and management conservatism. Hence, it can be concluded that the problems of producing segmental data with identification of segments, assets identification, choice of type of information to be disclosed, etc. are to be dealt with care in segmental reporting so that the report becomes useful to the investors. Thanks for watching my video.